Before dawn in Saskatchewan, the phones rang. Not orders, cancellations. 3 million tons of canola were wiped off the books overnight. $1.5 billion vanished before sunrise. Rail cars sat loaded, ships waited in Vancouver, all now useless. Beijing didn't debate, it diverted. By morning, the same orders carried a different flag. Australia's. The nation Ottawa hadn't targeted was suddenly the one China rewarded. Farmers stared at full silos, brokers at voided contracts, Ottawa at Washington, waiting for help that wasn't coming. Was this retaliation for steel tariffs, or a colder message about who's replaceable in China's supply chain? The knock on the bank's door was only the latest ripple. The chain reaction began weeks earlier. In July, Canada's Prime Minister announced a 25% tariff on steel products containing Chinese components. No warning, no transition. The official line protecting domestic industry from overcapacity risks. Behind closed doors, something sharper. Washington had just hit Canadian exports with a 35% tariff. Ottawa's sudden pivot against Beijing looked like an offering to ease American pressure. The logic was simple. Target Chinese steel, regain US market share. The logic was wrong. Beijing's answer was surgical. Within days, state-linked and private Chinese importers sent identical termination letters to Canadian grain traders. Effective immediately, no Canadian canola, no exceptions. This wasn't symbolism, it was a $1.5 billion redirection of trade flows. Ships in Vancouver sat idle, prairie containers baked under a sun that meant mold and spoilage. By week's end, Canberra had signed new contracts, up to 3 million tons of Australian canola over the next 4 years. For Australia, it was a comeback few predicted. Since 2020, their canola had been locked out of China over quarantine disputes and blackleg disease. Overnight, those restrictions evaporated. The irony was hard to miss. Australia had been a model ally in US policy against China. Now it was welcomed back, while Canada, another close US ally, was frozen out. Canada's canola sector was exposed. In 2024, more than one-third of its exports went to China, supplying around 40% of China's total demand. That's not diversification, it's dependence. Canadian canola's oil yield, around 44.6%, made it one of the most efficient oilseed crops in the world, prized in Asia for cooking oil. But efficiency means nothing if your biggest buyer walks away. In Saskatchewan and Manitoba, farmers opened warehouse doors to see yellowing seed piles. Prices fell 12% in a week. Equipment orders were canceled. Rural banks quietly restructured loans, bracing for defaults. In Ottawa, trade officials talked about exploring new markets. Diplomatic code for scrambling to unload millions of tons into countries with neither the capacity nor the appetite to take them quickly. Australia wasn't dealing with surplus. It faced one of its smallest harvests in 5 years, just 5.7 million tons after bad weather. But it played the long game. In July, Prime Minister Anthony Albanese visited Beijing with agriculture officials and industry leaders. They worked out phytosanitary rules, trial shipments, and a timeline. Days after returning, Australian traders booked vessels. Short-term volumes didn't matter. Securing China's long-term demand before Canada recovered did. Russia saw the opening too. A decade ago, it produced barely 500,000 tons of rapeseed a year. By 2021, 2.8 million tons. Last year, a record 4.22 million. By 2025, projected near 5 million, with Siberia emerging as a powerhouse. Unlike Australia, Russia already had momentum. Its rapeseed exports to China had nearly tripled in a year. Moscow was building a grain hub on the Sino-Russian border to push oilseeds, soybeans, and grain into northern China faster. For Beijing, this wasn't just about punishing Canada. It was about diversifying supply so loyalty mattered less. If one supplier faltered, another could step in without disruption. Canada's vulnerability was structural too. Over 70% of its energy sector and half its manufacturing were under US ownership. 3/4 of exports went to the US. That meant confronting Washington was politically risky, yet accommodating it risked blowback elsewhere. In this case, the price of accommodation was unsold grain and furious farm lobbies. And the steel tariffs that started it all, they weren't even decisive. Chinese steel made up only 18% of Canada's imports, far less than the US share. But symbolically, they aligned Ottawa with Washington's anti-China stance. In trade diplomacy, symbolism is never free. The most striking detail isn't that Canada lost China's market, it's how fast Australia took it. Less than a month separated Canada's tariff announcement from Australia's deal. That wasn't improvisation, it was preparation. Western Australia's ports like Albany and Port Lincoln are built for bulk grain exports to Asia. Sailing time to China, 7-10 days compared to Canada's 30+. In commodity trading, that's not just a logistical edge, it's a financial one. Lower freight costs, less spoilage risk. Canada's grain must travel by rail to Pacific ports before heading across the Pacific. Rail bottlenecks, labor disputes, and weather delays stretch timelines by weeks. In a competitive tender, those delays become part of the price, and this time part of the reason the bid wasn't even considered. The political fallout was immediate. Farm groups accused the government of sacrificing agriculture for steel politics. Opposition parties demanded hearings on why no backup buyers were secured before antagonizing their top customer. Ministers spoke of new markets in Europe and Southeast Asia, but insiders knew the reality. Europe already grows its own oilseeds and Southeast Asia prefers palm oil. And the US, the market Canada had tried to please, it kept its 35% tariffs. Canada traded a guaranteed high-value market for a possibility, and that possibility never materialized. For China, the canola shift sent a message: market access comes with conditions, and replacements are always ready. For Australia, it was proof that disputes can be shelved when mutual benefit appears. For Russia, the gains were quieter but strategic, building capacity now to step in whenever China needs volume or leverage. By autumn, the shift was clear in trade data. Canadian canola shipments to China, 0. Australian volumes, small for now but set to surge next season. Russian exports, record highs. For commodity markets, it was a live demonstration of how quickly trade can reroute when politics intervene. In rural Canada, the personal toll grew. Full storage meant farmers paid to keep unsold crops from spoiling. Credit tightened for next year's planting. A crop that once symbolized Canada's agricultural strength was now a cautionary tale. The lesson? Leverage doesn't come from loyalty, it comes from being irreplaceable. And in a single season, Canada showed it was replaceable. Australia proved it wasn't.